Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's Saturday morning, August 1st, 2015, and the title of this week's audio blog is Palatable Fear of Billions Worldwide. Now, sometime in the not-too-distant future, perhaps very not-too-distant, I'll again sleep late on weekends instead of awakening early to script audio blogs. However, with the endgame of global economic and monetary collapse clearly upon us, and the precious metal community as fearful as at any time in the 13 years I've been part of it, there's not a chance I'll sit idly when I have such a fantastic platform for spreading truth. And after all I've been through, not just since going all in precious metals in 2002, but a 26-year financial career in which I've watched everything I've ever learned turned inside out by corruption, deception, and criminality, I've come to feel an obligation to lead those in search of leadership. Though I doubt David Schechtman ever expected the Miles Franklin blog to be a leading source of global financial truth dissemination, it most certainly is. And as the firm's marketing director, I'm honored to be a significant part of it. That said, the week that was could not have more emphatically validated the title of last weekend's audio blog, Has the Big One Commenced? Which is why I gave this week's episode an equally powerful title, as aside from the 1% benefiting directly from history's largest money printing orgy, the world's population, one way or the other, is in some shape or manner suffering greatly from it. This is why, no doubt, Andy Schechtman and my presentations at the Sprott Conference in Vancouver this week were standing room only, and why never has a statement been more apropos than Societe Generale's Albert Edwards yesterday that, quote, I have not one scintilla of doubt that the Western central banks have set us up for an even bigger version of the 2008 Great Financial Crisis recession. But this time, rock-bottom interest rates and large fiscal deficits will mean only one thing. QE will be stepped up to such a pace that you will hear the roar of the printing presses from Mars. Frankly, there are so many horrible headlines to discuss from the past 48 hours alone, I don't know where to start. So why not go with the core of the world's problems, as described by Monsieur Edwards above, which is the conundrum faced by the world's largest hedge funds, i.e., the psychotic central banks that got us into this mess by abusing the world's longest, broadest fiat currency regime, by deforming securities markets and economic activity alike, and setting us up for the greatest financial collapse in global history, which for countless billions has already begun in earnest. No one has done a better job at describing such madness as David Stockman, whose Bathtub Economics Brigade article from this week is a must-read, regarding just how hopeless America's economy has become. This week's comedy of an FOMC statement, in which the best it could do, amidst an accelerating implosion of not just the American economy, but standard of living, was add the word "some" to its policy statement, giving a perfect example of just how hopeless the situation has become and how ignorant the world's supposedly smartest financial minds really are. In other words, a seminal emperor has no clothes moment, which undoubtedly will be compounded with countless others in the coming weeks, months, and years. Incredibly, there are actually people out there that believe the more than 2-year-old propaganda of not only U.S. economic recovery, but that the Fed will actually raise interest rates amidst not only an expanding global depression, but an environment where, no matter where you look, debt is at an all-time high level, expanding exponentially, is beyond me. And nowhere more so than the Fed itself, whose $4.5 trillion balance sheet of toxic, high-duration treasuries and mortgage bonds will implode if rates tick even slightly higher. And then there's the veritable mountain of negative economic news to contend with, of which perhaps a dozen separate topics in and of themselves would be enough to prevent rate hikes in a normal market environment, let alone when all of them are screaming the same historically dovish message, utterly daring the Fed to try and convince the world it's in control by pulling what would be a suicidal act in attempting to raise rates even a measly quarter point. And again, I cannot emphasize enough that, contrary to the relentless propaganda, even if the Fed were able to manipulate stock and bond markets high enough to even attempt such lunacy, it would not have the slightest impact on gold and silver prices. Contrary to said propaganda, particularly the Gibson's paradox garbage invented by then Treasury Secretary and now Chief Private Propagandist Larry Summers, there is no inherent relationship between interest rates and gold prices. Just as, by the way, there is no such relationship between the, quote, dollar index, i.e. the exchange rate between the dollar and the euro, and gold. And frankly, with gold and silver prices having been manipulated this far below the cost of production, amidst an environment of record exploding demand, scarce vanishing inventories, and soon to be permanently collapsing production, it matters not whether the Fed funds rate is 0, 1,000%, or negative 1,000%. That said, here's but a small sampling of the reasons why the Fed would be insane to do anything other than lower rates in the coming months and subsequently initiate a round of QE, putting all previous schemes combined to shame. In no particular order. Number 1, second quarter GDP growth, which in and of itself was dramatically overstated by myriad borderline criminal adjustments, not to mention a comically understated inflation deflator, came in way below expectations at just 2.3% versus the consensus 2.9%. Yet again, the Fed's own GDP Now tracking estimate of 2.4% was essentially right on target, which is why it's so comical that Wall Street continues to assume higher numbers. And as bad as this number was, what was even uglier was the double seasonal adjustments that were supposed to have boosted prior growth estimates, which, when all was said and done, may have marginally boosted first quarter estimates over the past 3 years, but took the sum total of all 4 quarters significantly lower. Yes, my friends, it turns out that the average 2.3% GDP growth of the past 3 years, in and of itself the weakest recession recovery of the post-World War II era, is now just 2.0%. In other words, 14% of all the growth that was purported over the 3 years was eliminated by the adjustments that were supposed to make them go higher. And worse yet, 2015 is on a pace to be the weakest year of all, before the commodity prices plunged to multi-decade lows as of yesterday's close. Which brings me to not a chance in hell of a rate hike reason number 2, i.e. the utter freefall of commodity prices that I, perhaps above all others, have screamed warnings of for nearly a year now. Starting with WTI crude oil prices, which after having plunged nearly 4% yesterday alone to $46.75 per barrel, are within $4 per barrel of the 6-year low of $42.35 per barrel experienced in March, and before that at the height of the financial crisis of early 2009. As I've exhaustively discussed, no business is more crucial to the finances of the world's corporations, municipalities, and sovereign nations than commodity sales. And with not only the weakest economic demand since the 1930s, but the greatest level of oversupply, which I might add will likely last for years, if not decades, the odds of the CRB commodity index's 40-year low of 185 compared to yesterday's close of 202 being significantly breached are as high as they can possibly be. And frankly, outside of the increasingly likely possibilities of hyperinflation and/or war, I find it difficult to believe this level won't be sliced through shortly, like a knife through hot butter. And by the way, OPEC won't be able to support prices either, particularly now that last week's Iranian peace deal will be sure to swamp an already heavily glutted market for years to come. Just yesterday, OPEC's Secretary General himself said so, taking away the last glimmer of remaining establishment hope in claiming OPEC was essentially helpless to arrest the oil price collapse. Number 3, currencies the world round are being destroyed at a record rate, particularly so-called commodity currencies whose national economies are dominated by said commodity sales. Again, the average global currency is down more than 50% against the dollar, and the average BRIC currency down 90% since the Fed commenced Operation Twist and QE3 in 2011, exporting more inflation in a mere 4 years than the world has ever seen. Subsequently, the final currency war I warned of in early 2013 has gone nuclear, although sadly it's just beginning. Consequently, global purchasing power is collapsing, which is probably why gold prices, relentless cartel attacks notwithstanding, are at or near record levels in the majority of the world's currencies. To that end, the resulting strong dollar is utterly destroying what remains of America's manufacturing base, prompting everyone from corporate CEOs to the White House itself to whine as loudly about the strong dollar as Japanese leaders of the strong yen and Mario Draghi of the ECB, who ironically believes doing whatever it takes to save the euro means diluting it into oblivion with not only one of history's largest, most open-ended QE schemes, but negative interest rates as well. And by the way, if you think said final currency war is ugly now, just wait until China inevitably depegs the yuan from the dollar, under the same pressure of a collapsing manufacturing market share that the strong dollar is pegged to is experiencing. Which brings me to number 4, i.e. the pink elephant in the room, that is the ongoing collapse of the historic Chinese stock bubble, the second such bubble the PBOC has fostered in 8 years' time. As if the Chinese economy, objectively at its weakest level in 35 years and rapidly imploding, wasn't enough, literally trillions of paper wealth have disappeared in the past 6 weeks, with the Shanghai Exchange down 29% despite the most blatant central bank intervention on record. Unquestionably, the Chinese economy will be dramatically impacted, causing a global ripple effect that will feel more like a tsunami. And this starting from a base level that was already in Great Depression territory, already featuring multi-decade lows in commodity prices and all-time highs in debt of all kinds. And given that China has been, by far, the world's largest commodity user for decades, what I said earlier of the impending collapse of everything from oil to copper to even many agricultural items, brace yourself farmers, may woefully understate just how bad things are about to get. Number 5. Countless near-term debt default candidates, starting with Puerto Rico this weekend, and likely by the end of August, Greece. Regarding the former, this quasi-U.S. state's $72 billion of debt is likely to officially default within days. And as for Greece, where not only is no bailout deal in place, but never was, the odds of it failing to make its August 20th payment due to the ECB of 3.2 billion euros is essentially zero. As Mark Grant of Southwest Securities calculated this week, Greece's real debt is closer to 600 billion euros than the propagandized on-balance sheet level closer to 350 billion, as if that wasn't enough. And thus the odds of a new $90 billion bailout being agreed upon, which in all likelihood would need to be closer to twice that level, let alone with the IMF now appearing unlikely to participate, are as close to zero as can be. So, my faithful readers, it appears my prediction of a guaranteed Grexit remains on target, likely by year-end. Number 6, which, by the way, will coincide perfectly with December's Spanish prime ministerial election, January's in Portugal, and the likely UK Brexit vote in early 2016, which in turn will inflame already powerful Euro exit movements in places like Italy, where youth unemployment surged to an all-time high last month, and France, whose collapsing economy will shortly meet head-on with Marine Le Pen's inevitable presidential election victory in 2017. As for number 7, on my list of reasons there's not a chance the Fed will be raising rates anytime soon, if ever, is yesterday's horrifying data depicting that during July, America experienced its lowest rate of wage growth ever. In other words, not only is the employment component of the Fed's two-headed monster of key indicators collapsing, per the 38-year low in the labor participation rate and said collapsing wage gains, but the deflation implication of such a weak reading destroying any possibility that the government-rigged CPI will reach the Fed's 2.0% target anytime soon. Heck, even gold prices surged higher when this number was published, whilst interest rates plunged to multi-month lows and commodity prices collapsed. And by the way, shortly after the horrific wage gain number was published, talk about the deflationary implication of America's new, quote, gig economy reached a fever pitch. And by gig economy, I'm referring to the fact that, due to America's businesses being so heavily overregulated, including Obamacare and mandatory minimum wage increases, for example, employers are doing whatever it takes to reduce full-time employment, which subsequently yields inexorable downward wage pressure and the rendering of once ubiquitous benefits like health insurance to mythical unicorn status. Not to mention the fact that part-time contract or gig workers cannot file for unemployment insurance when they lose their jobs, explaining why weekly jobless claims are at 50-year lows, contrary to Washington and Wall Street propaganda that it is due to a strong, recovering economy. I mean, what part of the labor participation rate also being at multi-decade lows, as well as real wages, do people that believe such drivel not understand? And bringing the point home, this week we saw some of the largest collapses in U.S. consumer confidence and comfort on record, And this despite said recovery and near record PPT orchestrated stock prices, which admittedly are dramatically weakening. To that end, the data point that said it all, that is, aside from record low home ownership and record high rents, in my view, was the fact that 70% of Americans expect the economy to weaken. And I kid you not, exactly 1% expect it to strengthen. Gee, I wonder which 1%. As for precious metal prices, they ended the week largely unchanged, amid some of the most flagrant, relentless cartel raids imaginable. At the same key attack times as usual, with the same algorithms as always, as exemplified by yesterday's prototypical Cartel Herald capping algorithm at the 10 o'clock a.m. Eastern physical market close. At exactly the $1,100 per ounce line in the sand, said cartel has been staunchly defending for 2 weeks in gold and $15 per ounce in silver. That said, physical demand is rocketing skyward, while its inventories are collapsing and the demise of the mining industry I have long warned of has arrived, as exemplified by last week's announcement that Anglo-American plc, one of the world's largest diversified mining companies, lost $3 billion in the first 6 months of 2015 and are consequently laying off 53,000 employees, or 35% of its entire global workforce. Regarding demand, the U.S. Mint reopened Silver Eagle sales on allocation last week, which despite being suspended half the month, yielded the most ever Silver Eagle sales in the July month. In fact, year to date, U.S. Mint Silver Eagle sales are 5% ahead of last year's record pace, making the nonsensical collapse of paper prices appear that much more blatant to the entire world. Moreover, silver physical premiums remain elevated, particularly for what I deem the ultimate fear asset, junk silver, which, by the way, everyone must own, as one day it may become the world's most desired silver asset. As for gold, July was also an enormous month for U.S. Mint Gold Eagle sales, as it was for Shanghai Exchange physical gold deliveries. And oh yeah, get this, not only did COMEX registered gold inventories hit an all-time low of just 376,000 ounces this week, worth a measly $411 million, or probably 1/100th of all the paper contracts outstanding, but the net short position of COMEX commercials, and by commercials I mean government henchmen like JP Morgan and Goldman Sachs, that plunged to just 15,000 contracts as of Tuesday, representing their smallest short position since, drumroll please, December 2001, when prices were just $277 per ounce. And ditto for commercial silver net shorts, which are also as close to being unwound as at any time since 2001. As for the mining stocks, what more do I need to point out than the utter collapse of the Huey Mining Index to levels nearly 50% below the 2008 lows, with many companies clearly on the verge of bankruptcies, their stocks obviously starting to discount the near certain massive write-offs that will come by year-end if gold, silver, and other metal prices don't immediately and dramatically rebound. At this point, I'm not going to rehash the dozens of dire, powerful warnings of the dangers of mining stocks I have given over the past 12 months, or for that matter, the past 4 years. However, yesterday's article, Waiting for a Bubble to Bail Us Out, is a must-read for anyone trying to fathom just how dire the mining industry's plight has become. In it, I describe, nearly verbatim, the horrific outlook espoused by none other than Doug Casey on Wednesday morning, who spoke directly after Andy Schectman, ironically, in predicting modern mining companies would all but disappear in the coming years, and he who had been one of the mining industry's most powerful advocates for years. Well, especially given my experience in owning mining shares and working in the mining industry from 2002 to 11, I'll not be shedding any tears for these horribly run companies who, aside from working in the world's most difficult industry, issued nary a peep about the manipulative price suppression that has destroyed them. To that end, no one could have said it better than GATA's Chris Powell in an interview this weekend. Quote, "The mining industry is thinking that it should just die quietly and obediently. I think its value is likely to fall to zero, and its executives will have nothing to say for themselves or the companies all the way down. The industry is worthless, and not so much because of the attack on the monetary metals by central banks. To the contrary, it's worthless because its own shareholders and executives are content to die quietly. If the industry will not stand up for itself, I have no idea why anyone would want to invest in it." As Casey espoused, giving the article its namesake, at this point the only thing that will save mining share investors, both pace and precious metal alike, is the commencement of an historic bubble. Per above, the odds of a base metal mining bubble are below zero. And as for gold and silver, an historic bubble must inevitably form. However, when it does, coincident with collapse in confidence in worthless fiat currencies, you can bet governments will nationalize and/or windfall profit tax all gold and silver mines, making it essentially impossible to profit from their ownership. And before I go, there's one more topic I feel the need to address, demonstrating all that's wrong with the world, as well as just how tip of the iceberg the problems thus far have been, which is the Swiss National Bank. You know, the supposedly ultra-conservative financial leadership of the world's supposedly savviest financial population, announcing a massive $50 billion Swiss franc loss in the second quarter, which, relative to the size of the tiny Swiss economy, would be the equivalent of the Fed announcing a $2.7 trillion loss, or more than half its entire balance sheet. Yes, the SNB, who led by Lady Macbeth Thomas Jordan, who I so named because he doth protest too much to the November referendum to save our Swiss gold, not only destroyed Switzerland's finances by pegging the franc to the euro, ironically, on September 6, 2011, mere hours from the coincidental paper raids that knocked dollar-priced gold down from its all-time high of $1,920 per ounce and silver from $45 an ounce, but has lost countless billions on all manner of speculative positions, including, by the way, stocks, which incredibly the SNB admits to owning a whopping $94 billion worth. In time, the entire world will realize that not only the SNB, but the Fed, ECB, and other central banks have been covertly buying stocks all along, just as the SNB and Bank of Japan, among others, have been doing so overtly. And once stocks inevitably collapse, not to mention the historically overvalued sovereign mortgage and corporate bonds they all overtly own, the balance sheets of said lenders of last resort will vanish into dust, as will confidence in the worthless fiat currencies they hyperinflate, which sadly has already occurred in many of the world's nations, with only its leaders still standing, soon as the soon-to-be-destroyed Bank of England, ECB, and Federal Reserve. To that end, we can only reiterate as vehemently as possible that the time is now to protect yourself while you still can. Here at Miles Franklin, we have conducted business for 26 years without a single registered complaint, and can help you not only with the purchase, sale, or storage of precious metals, but a variety of financial planning strategies we have honed over 2 decades of working with gold and silver. In fact, not only did I tape the aforementioned podcast with Miles Franklin's president and co-founder Andy Schechtman earlier this year regarding swaps, trades, and repatriations, but 2 weeks ago, the state of the bullion industry, in which Andy spoke of matters investors must be aware of in the current environment, featuring, by the way, this week's Chapter 11 bankruptcy of longtime low-price competitor Bullion Direct. As for Miles Franklin, all we ask is that you give us a call at 800-822-8080 and allow our staff of professionals